we're going to pass 3%, it looks like. It might take a little bit of an effort, but we're going to do it.
We think higher. And I think when you look about the last several weeks, what's been impressive is yields really never went down. Despite all the headlines, despite all the stress out there, the best they did was maybe 275 or 280 on bond yields. We were impressed by that. Getting up through 295 is an important hurdle. And we think ultimately 325, 330 is still the target. And when you look at the entire curve, it's not just 10s. 2-year yields are at 10-year highs right now. The 5-year yield is at an 8-year high. 30s aren't too far behind, so it's the whole curve that's breaking out here.
Why the hysteria, or at least maybe that's too strong a word, but there's at least an uncomfortableness about curve flattening. We're still a good, between 40 and 50 basis points of a spread there.
We must have read this weekend 15 or 20 headlines really explaining this hysteria, and we think it's overdone at this point. The spread between 2s and 10s is still about 50 basis points. Historically, when you're in this 50 basis point range, you've had about another year before the curve inverts. And I also think it's important to emphasize this has been a bear flattener, meaning the curve has flattened because bond yields have gone up, not down. It's when you get a bull flattener, when the curve is flattening because bond yields are going down, that's often far more ominous for global markets. So that's not what we've seen. We've seen this bear flattener, higher yields. That tends to be better for risk assets.